afternoon. Thank you so much for joining us on today's webinar. We're going to talk about Maine's mandatory retirement law that is going into effect next year. This is going to affect a lot of our clients and a lot of small businesses around the state. So at Paper Trails, we always want to make sure that we're keeping everyone informed about what's going on. Lots of heavy lifting going forward for many small businesses with this program. So let's get rocking and rolling and talk about that. Today, we're going to talk about what the Maine Retirement Savings Program is and how to stay compliant with it. And then we can talk about a couple of different retirement plan options for small businesses and how we can help. And then we'll take some questions at the very end. So let's get started with the basics. So last year, in June of 2021, the governor signed into law an act to promote individual retirement savings through a public-private partnership. This was LD 1622. This had been going through the legislature for a few years, but finally gained some traction out of committee and came out and went to the governor in June. So went into place. Reasons for the legislature passing this were there's about 500,000 private sector employees in the state of Maine, of which only about 41% of those private sector employees have access to some sort of employer-sponsored retirement plan. So this has been going on around the country. I think there's about 8 other states that have enacted or are enacting a very similar program to this. So it's a pretty popular subject across the state, across the country. And we certainly know that in the state of Maine, most of our employees work for small businesses, right? So a little over 100,000 people work for businesses with less than 25 employees. So, and we know that the barrier to entry for employer-sponsored employer-sponsored retirement plans gets even higher when the number of employees in the business goes down. I did create a tiny URL link, so if anyone wants to go actually read the whole bill, it's quite riveting if you've got the time and energy. So you can just go to tinyurl.com/Maine-retirement. That's a link directly to the bill that was passed and signed into law, and everyone can go take a look at that if you have specific questions about what the law entails and how it works. The law is basically broken down pretty simply. So a covered employer must offer an employer-sponsored retirement plan to their covered employees. We talk about covered. We'll get into the specifics of that. If they don't offer an employer-sponsored retirement plan, then they have to automatically enroll their employees into the state-sponsored retirement plan. We'll talk about what that looks like. The Maine Retirement Savings Board has been commissioned and they have been meeting and they're starting to put this program together for the state-sponsored retirement plan. And we'll talk a little bit about that as well. When we talk about what a covered employer is any for-profit or nonprofit entity in operation during the current or prior calendar year. So this does not include federal or municipal or governmental entities, but basically any for or nonprofit entity that has been in business for basically a year or longer is a covered employer and has to abide by this law. So that's really important. If you're a brand new business and you have 5 employees, you don't have to do that, but after a year, you've been in the prior and the current calendar year, you will become required to comply with this. Under that, once an employer is determined to be liable under this program, then you have to look at the covered employees. Covered employee is basically anybody 18 or older, doesn't distinguish whether it's full-time, part-time, seasonal, temporary. Any employee 18 or over that works for a covered employer must be covered under these plans. So that is a nice distinguishment there. There is no carve out for seasonal employers. So just like there's an employment, there is a provision for seasonal employers. That does not exist under this program. So even if you only operate for 12 weeks a year, for example, you're a summer ice cream shop, you will still have to comply. Anybody 18 or over will have to be allowed to participate. So when we talk about the retirement savings program, we don't know everything yet. This Retirement Savings Board is still working on this, developing the plan. We do know that the Retirement Savings Board is probably going to latch on to another state. We may partner with another state, perhaps New Mexico, who's also developing this plan right now. There's a couple of other states that are working through this. So we don't know a whole lot, but what we do know is, as is written in the law, employees that use the retirement savings program, this is again that state-sponsored plan that they're building. If you choose to use a state-sponsored plan, employees will be automatically enrolled in the state-sponsored Roth IRA plan if there's no employer-sponsored plan. So the state is going to be setting up Roth IRAs for every employee that's in this program. A Roth IRA is a post-tax contribution to retirement. So it's a special type of IRA. There's no pre-tax benefits to the employee at the time of contribution. However, the nice thing about a Roth is that when you take that money out at retirement age, that is not taxed at that time. So you pay the tax basically up front. That's a special provision of the tax law. There are contribution limits to a Roth IRA, which will apply to this, which we do know. For 2022, the income contribution limits are $6,000, or if you're over 50, you can contribute an extra $1,000, so $7,000. Other limitations of a Roth IRA that may become a problem with this is there are income restrictions under this. So if you're a single individual, by the time you're on $144,000 a year, or a married individual up to $214,000 a year, this year, 2022 numbers, then you may no longer be able to contribute to a Roth IRA because of the tax rules. So that's a challenge we don't have an answer to yet. And that's something that I've actually asked the state treasurer about. Potentially could be an issue for some folks. Automatically, if an employer is in this role, if they come in and they get hired by you, you must take 5% of their first paycheck and put it into this retirement plan. So that's an automatic enrollment for all new employees, okay? Now, they can certainly choose to do more or less if they want in writing, but if they do not sign up or opt out in writing, you must take 5% of their very first paycheck and send it to the state into their Roth IRA. So that's going to be a big deal for a lot of folks and something we're going to have to really pay close attention to. This will increase automatically 1% per year up to 8%. That's in the law. So if they're just default in the plan, their contributions will go up 1% every year up to 8% and stop. So the employees do have the opportunity to opt out, does have to be in writing. In the law, there is a provision that says they can automatically be re-enrolled if they need another opportunity to opt out at regular intervals. We don't exactly know what that's going to look like yet from a compliance perspective. That's one of the questions that we have, but that is in the law that if an employee opts out, they may have to opt out multiple times, once a year or so forth, to continue to be opted out. And again, that will come down to the rules that the Maine State Retirement Board writes for us in the next several months. So that'll be interesting. Employers do not have to match any contributions. So if you choose to use the Maine State Savings Program, you do not have to put any employer contributions in there. All you have to do is take money out of an employee's check and send it off to the state, which of course we would do through payroll for you as well. But that definitely is a nice feature of this, is that there's no employer truly expense other than the administrative cost of doing that. So those are a lot of things we know about the program. Let's talk a little bit about things that we don't know, right? So because this program is still being developed, we have no idea what enrollment is going to look like for the employer or the employee. We assume that the employer, just like for unemployment, is going to have to sign up as an employer in this program, and they're going to have to register and sign up their employees every time they have a new employee come on and become a participant in this plan. That's how other states are doing it, so we assume that that's probably what's going to happen here as well. Again, we don't know how contributions are going to be made to this program. Will they be online through a portal? Can we mail a check to the state? Will there be some sort of payroll integration so that we can automatically transmit contributions off to the state? We don't have those answers yet either. Again, what we're seeing in other states is there are online contribution options. Some states, California, for example, does have a payroll integration. That'd be really nice if we could get that in here as well. So those are questions that we don't have. And again, we've asked of the state how this is going to happen as well. We really don't have any understanding on how this is going to impact the cannabis community. So we all know the 100-pound gorilla in the room is that cannabis folks can't bank. They can't be put in anything federally regulated. That generally includes investments. So this is a Roth IRA. It's going to have to be traded on the public market. We're not sure how that's going to happen. We called a couple of other states, Colorado and California, and said, hey, how do your cannabis businesses do this in those states? And the expectation in those states is that they will contribute to this program. So obviously the fiduciaries in this situation know that money is going in there, but that is obviously, we have a large cannabis community here in Maine. Lots of questions about that, what that's going to look like. I also have some questions on how this is going to impact the restaurant community and tipped employees, because a lot of restaurant servers are getting zero checks. So if there is no money in their check, how are they going to comply with that 5% deferral, right? So that is definitely a question that is out there for us as well. And we've asked that of the state as well. So lots of questions around that. So this program goes into effect starting next year. So starting April 1st, 2023, employers with 25 or more employees will have to comply with this law. Again, that means whether they have an employer-sponsored plan or they enroll in the state's plan, they will have to start complying with this. The state is working very fast. That Retirement Savings Board has been sat. They've met several times. They're working on hiring an executive director, getting through the program, and they are working towards that April 1st implementation for those Roth IRAs that we've talked about. So April 1st next year, the first phase of this goes in with 25 or more employees. Starting October 1st of next year, employers with 15 or more employees are going to have to comply. And then on April 1st of 2024, that's the final phase of deployment. And that will be all employers with 5 or more employees on them, on their books, will have to comply. Our understanding at this point, again, another question we have is this is a true body count. So if you have 5 bodies who work for you, this is not a full-time equivalent count. Similar to how Maine paid leave works, it is if you have 5 individuals working for you, whether they work an hour or 40 hours a week, you will fall into the bucket of having to comply with this. So again, that we'll probably get some more guidance on that, but that's my understanding at this point, how that's going to happen. So we talked about how to stay compliant in this plan. So you either must offer an employer-sponsored plan, and this has to be a qualified tax-advantaged retirement plan, and that is in the details of that are in the law, which you can link to that tinyurl.com/Maine retirement. You can read that. It defines what a qualified tax benefit employer-sponsored retirement plan is. In the law, it does list 401A, 401K, 403A, 403B, 408K, which is typically called a simple IRA, which a lot of small businesses have, or a 457B. So those are the acceptable retirement plans under this provision. Doesn't seem to be a lot of rules around what eligibility rules you have to have or other mechanisms within these plans you need. But if you have one of those, you are in compliance, basically, is how the law is written today. Again, further guidance may come out from the board on that. So stay tuned for more information. We'll keep an eye on that. But right now, the way it's written, we understand it. If you have one of these retirement plans, you are okay. You are in compliance at this point. The option is to enroll your employees in the state's retirement program, which again is continually, we're getting more information on, and that will be set up before the April 1st rollout. So those are the 2 ways to keep in compliance, not get in trouble. So we are kind of encouraging folks to control their own destiny. Get set up for a retirement plan of your own. Get a state retirement, or get an employer-sponsored retirement plan. Get one of those 401ks. Get a simple IRA. Get something else that you can manage your business with. This allows you to control what rules and regs you want to comply with them. Every plan has different rules and regulations and eligibility criteria. But with a 401k, for example, you have a lot of control over what how you can set that up. So eligibility rules, you can set hours of service requirements, age requirements, and so forth in there, which could benefit you as well, rather than having to automatically go through this. The other item to consider as you're setting up a retirement plan is there are tax credits. You can get up to $5,000 per year for 3 years in startup plan expenses, administrative costs credited back to you when you do your taxes. If you do an automatic enrollment in that plan, you can get an extra $500. So it's in essence about $16,000, $16,500. You can get in tax credits in any startup costs, administrative costs, plan sponsor costs for the first 3 years that you have this plan in place. So keep that in mind. That's another benefit to you. The government has put this in place to help you as you are getting your plans put into place. So you definitely have more flexibility with investment choices, contribution amounts, eligibility decisions when you have your own plan. You use the state's plan, you're at the mercy of what the state is telling you have to do under their provision. So if you don't want to be told what to do, you can choose your own plan and do that as well. Always, employer-sponsored retirement plans are generally speaking pretty low-cost employee benefits to offer. If you're looking at a 3% wage match or something like that contribution, it's a relatively inexpensive benefit to offer to your employees, and it's a really great tool for retention. So we see a lot of folks that use retirement plans in their businesses to keep employees engaged and happy as part of their compensation package. These are kind of the 2 most common small business retirement plans, a traditional 401k or a simple IRA. There are some just key differences. There are tons of minutia in between them, but here's a little bit of a high level overview of these 2 plans. So with a 401k, a business of any size, 1 to 1 million employees, can have one. The simple IRA, however, is designed for employers with only under 100 employees. So if you get above that, you're going to phase out of that simple IRA and it's not going to work. Because the simple IRA, just as it's mentioned, is pretty simple. There's not a lot of admin overhead. There's not a lot of regulation that goes along with that, or admin time that goes along with it. You can't put as much in, right? So you can only put $14,000 away as a salary deferral. If you are over 50, you can do a catch-up of $3,000, which gets you to $17,000 total. Whereas for a 401k, you can do $20,500 with a $6,500 catch-up if you're over 50 as well. So you can put much more away in a 401k than you can with a simple IRA. There are other options for discretionary contributions from your employer, profit sharing, safe harbor contributions, lots of different tools that you can use with a 401k to actually potentially put more than that $27,000 away, but that's a standard deferral as well. So there's a lot more tools in your toolbox with a 401k than a simple IRA. Under a 401k, you do not have to do an employer contribution, right? You don't have to do a match or a non-elective contribution, but you can, and you can choose exactly how much you want to do. There's great flexibility in the design of those employer contributions as well. You could do 100% matches, you can do a discretionary contribution, a non-elective contribution, lots of options for employer contributions to those plans. With a simple IRA, you do have to contribute, a match, and we're going to see that right below. You'd have to do a 2% fixed contribution, even if the employee doesn't contribute, or a 3% match of the employee contribution, which is what we see most commonly, right? So most people are saying, if you match, I'll give you 3%. If they don't put anything in, then they have to do 2%. So there's a little bit there. For employer contributions on the 401k, you have to do a proportional contribution for everybody that's eligible. You have to do some testing to make sure there's not a disproportionate issue there for highly compensated employees. You're going to see that administrative testing happen at the end of the year with the third-party administrator. So there is a higher burden of admin time and expense on that. You're going to have a third-party administrator. You're going to have to do testing, make sure that there's not one individual that is getting more benefit from the plan than another, and so forth. So there's definitely things to consider when you're looking at a 401k. With a simple IRA, there is not really a lot of customization. This is the plan. This is what it is. But there's no admin cost, there's no testing, there's no annual review, there's no fees to the employer. Again, it's simple. That's what attracts a lot of people to that. So these are the most commonly used small business retirement plans to consider as well. So when we talk about implementing all of this, we're here to help. We're here to be your partner in this. We want to make sure that you are reducing the burden on yourself as much as you can. And that we do that with just about everything we can. But we have a direct integration with most retirement providers. So if you're doing a 401k and you have a John Hancock or an Empower or an American Funds 401k, we can make your contributions automatically for you. That saves you from having to log into the benefit provider and have to make those contributions every payroll. So we have a direct integration with about 60 different carriers that we can send those off for. Just save a little bit of data entry and time on your end. With every retirement plan, whether it's a 401k, simple IRA, whatever, we will build out that plan with all its rules and regs and specs within our system, within iSolved, so that we know exactly when an employee needs to be enrolled, how much they need to enroll. If there's an automatic enrollment, we can set that up automatically. If you want to use our open enrollment tool for all of your benefits administration within iSolved, you can do that. They can choose their health insurance, dental insurance, retirement, whatever, all those contributions, those flow right into payroll, flow right over to your benefits carrier. And that works really nice as well. And then at the end of the year, whenever you need it, each payroll end of the year, we can have custom reporting for you that makes that administrative burden that much less. So if you need a special report every payroll or at the end of the year for your third-party administrator, we can get you that as well. We also work with a ton of financial advisors and retirement plan providers that we can refer you to. So we are not a retirement provider. We don't offer 401k. We don't have any of that in place today, but we definitely have a lot of folks who we work with that we can refer you to get something like this set up. So if you don't want to use the state's retirement plan and you want to set up a simple IRA perhaps or a 401k or talk to someone, we can get you in touch with the right people to do that. And the folks that we work with are phenomenal. We only send people off to people we know and trust. So that's a great benefit as well. And then we talked a little bit about this, that custom exports and reports for the end of the year, that testing. We can get all that paperwork and testing off to your third-party administrator if there's a 401k. that will really save you a lot of time in that way as well. So lots of benefits that we can offer to you. All of these are no cost to you. We just do these as part of our regular service. So there's no upcharge on that. So where do we go from here? So we know we've got to comply. What do we do here? We know that the state's going to start issuing a $100 penalty per employee if you're not in compliance. So keep that in mind. April 1st, if you have 25 or more employees, that's the deadline to be in compliance. So if you do want to set up a retirement plan, it's probably a good idea to start that process now so you're ready for January 1, because it generally takes a couple of months to get these things going. You want to get that process started sooner than later. It doesn't happen overnight. So keep that in mind. We will definitely keep an eye on the Retirement Savings Board to see what they've got going on. I've been attending all of their meetings, so I know where they're at, what's going on. They're still very early on in the stage. They're doing a lot of discovery. They do have a couple of consultants that they're working with to help guide them through that. It sounds like they're probably pretty close to hiring an executive director to help run this program in the long term. So, but we will definitely keep an eye on that and keep everybody informed on what is going on with that. So in addition to our webinar here, which is fully recorded and will be put on YouTube later this afternoon or tomorrow, you can download our compliance guide. There's a lot of great information, a lot about what we've talked about today. If you go to our website, papertrails.com/retirement, that is a full guide there for an ebook that you can review and have handy for any quick questions. That also does have the link to the official law and so forth in there. So next month, our webinar, October 18th, is our friends at LaBelle Harriman. We're going to talk about some student loan assistance programs and different ways that employers can help their employees pay for student loans. There are some tools perhaps within your 401k. There's some other reimbursement options that an employer can offer to their employee, just a different employee benefit to think about that we're going to talk about next month. And that's the 18th at 2 o'clock. You can sign up online for those. So let's hop into some questions. I know we have a few in the Q&A already. First one, we require 3 months of employment before a 401k kicks in, where we need to temporarily enroll the employee in the state program. At this point, the answer to that, I believe, is no. If you read the law in black and white, it sounds like if you have this plan, you don't have to use the state's plan at all for any reason. You get to design your 401k plan however you want, as long as it's in compliance with federal law and state law. You're not discriminating and so forth. So as far as I know today, there does not need to be any mix and matching of the program. Can we offer our retirement plan to full-timers and then the state for part-timers? Generally speaking, no. You need to have one retirement plan for your business, right? You definitely can look at some eligibility rules if you're using a 401k that may allow you to potentially limit, but not discriminate against those part-time employees. But that would be a question probably if you're a financial advisor and your third-party administrator if you're using a 401k. Question on, does the SEP qualify as an employer-sponsored plan? I do not believe the SEP is listed in the law, but Michelle, I will take a look at that. I'm gonna write myself a note and I will get back to you. If you do look at the law, go to tinyurl.com/mainretirement. It lists, and I believe it was just those 6 that are there, but I will find out for you and get back to you on that, Michelle. If we are seasonal and start in April with 2 bodies, and then October, and through October we have 15 to 20 employees, basically it's similar to my understanding. Again, we don't know exactly how this is going to work, Emily, from a seasonal perspective, but if the second you hit 5 bodies, you become eligible for this plan one way or another. They do have to be 18 plus, so that may help you as well. That's something to consider in your decision making. I'm happy to talk a little bit more offline about that. Similar to main paid leave, the second you hit 5 bodies, the expectation is that you'll continue to offer that in perpetuity until you reasonably believe that you're not going to offer this anymore. So definitely some things on here. To be super clear, we're currently offering a 401k. We're in compliance. Is that correct? So yes, my understanding today, if you offer any employer-sponsored plan that we listed, those 6 employer-sponsored plans, you are in compliance, regardless of the way the eligibility works or anything in that matter. The way the law is written, it seems to be that if you offer that plan, you are in compliance. The Maine Savings Board may come back with some additional rules. They're still working on that. We don't know what that's going to look like at this point, but my understanding, reading the law, if you have an employer-sponsored plan that meets those criteria, it's in that list, you're covered. Are the slides available in PDF? Yep, I can get these to you in a PDF. That's sure. I'm going to write that down. A lot of this content is also in our ebook that you can download at papertrails.com/retirement. You can get that. Most of the information is in there as well, but I'll get you PDFs of these slides as well, Dave. Has the board determined if there are ERISA issues that might negate this mandate? So I know there was a lot of research done on this as the bill was being written. It was changed many, many times. There are references to ERISA within the law. So it's definitely something that they're going to be looking into, I'm sure. But I think their charge right now is just getting this thing off the ground. So that's going to be the big thing. Yes, so Elizabeth, the question was, it's only 25 or more employees starting April 1st of 2023. That phases into 15 or more October 1st of 2023, and then 5 or more April 1st, 2024. So we do have a long runway for the smaller businesses. But yes, the program does start for large businesses next April. Does this include H-2B and J-1 employees? They're generally speaking, those employers are not United States citizens, so they would not have access to an investment vehicle like that. There is a carve out in the law for that, I believe. I'd have to double check on the definition of that covered employee. But I do not believe that those folks are eligible for this at all. If the employer has a plan but is ineligible due to years of service and they're 18 plus, are they required to be enrolled? Again, my understanding is if you have an eligible program, regardless of the eligibility rules that are within that program, you should be covered one time. Is the $100 penalty per employee a one-time fee? I believe in the law, they have the ability to do that as a recurring $100 per day fee. My guess is, and I know that the board has had this discussion at their meetings, they're not going to be penalizing people right off the bat. They're going to be educating and trying to get people on board before they do that. But of course, the board has whatever is in the law they can do to penalize you. So my guess is it's going to be a recurring fee, as that's how most labor laws are. Another question about the SEP. Again, that I do not believe that is in the law, but I will double check for you, Carrie, as well. I think it's just those 6 points. Henry, our state treasurer, he's on the line here. That's great. Important note that part-time seasonal employees, et cetera, may be considered covered, but that final decision will be up to the board. The board may well intend to decide on a narrower definition of employee. So that's really important for our seasonal businesses, right? So right now, they may be considered covered, but the board may make a decision at some point to exclude that, back that out a little bit more. So Emily and other folks that are on there, keep an eye on that. And again, we'll keep an eye on that as we're going. Henry's been great at communicating, getting us the links, and it's been really good. We're really impressed with that and the board. So, is the 100 employee rule for simple IRA an FTE rule or a physical employee rule? I'm going to defer to your financial advisor on that. I believe it is 100 bodies, not FTE, but again, I would defer to a financial advisor on that 100 employee for simple IRA. See. Will plans converting from a simple to a 401k be eligible for the tax credit? I think that's a great question. I am not 100% up to speed on that. I would defer to an accountant on that tax credit as how that would work. But I believe if you are converting to a 401k, that's part of the Safer or Secure Act. 2019, I think they did that. I believe the intent was if they're converting, they can do that again. But again, please, I would defer to an accountant on that question as well. Henry's got his hand up. I'm going to let Henry, you want to chat for a second here? I'm going to allow you to talk. Henry's our treasurer here at the state. He's been really great in getting this going. Hop on here and welcome, Henry.
Sure, Chris. Can you guys hear me okay?
Yeah, we got you.
Terrific. Well, thanks for doing this, Chris, for having this presentation, and thank you people for joining. We, any press is good press at this point, right? We want people to be aware of this program. We don't want to surprise people or confuse people. Chris covered it, and I will say a couple things very important to note, and there was an ERISA question as well. This is very much a program, not a plan, and I'm guilty of saying plan sometimes, but this will be a program. This will not be, say, a state of Maine, IRA, or we're not enrolling people in the state pension system. We'll be giving employers the option to give their employees the option to participate in probably a menu of options, probably simple options for an IRA. Employees can opt out, as Chris mentioned. What this means really, if you want to paint a picture in your mind, that first day of work for a new employee, you're having them fill out an emergency contact form and tax forms. You'll also effectively want to give them a form to opt out of this plan if they wish. That's what this program intends to do. And it's not an endorsement, a commercial endorsement, but yes, this does mean that you might be well advised to look at the commercial market beforehand. That's the intent of this law. It's to get people saving for retirement, not necessarily participate in this program or use the products in the state program. We want people saving for retirement. If we're doing that some other way, we're happy. And we're also happy to hear from you as the board makes rules about definitions, etc. So please do not hesitate to reach out to me or the board or the state with questions and with your input as well. Thanks, Chris.
Thanks, Henry. Appreciate it. I have another question from Michelle, who's an accountant, who says, while Henry's on the line, how can an employer or a payroll processor know if an employee is eligible for a Roth when the employee is not going to want to provide the full tax picture for their families? And I think that that's probably going to be an individual decision. And obviously, if someone that is not eligible for that, chances are they're probably going to know that. And I think 9 times out of 10, from my experience anyway, anyone that's earning that amount probably is going to have access to some other retirement vehicle as well. So that definitely was a question for me as well, Michelle, on those income limitations and how you're going to handle that. And I don't think we have an answer to that until maybe we get into it a little bit more. But it's definitely a question that I had sent to Henry, and I know he has on our on my question list. So that's definitely one for the list as well. So in the past, people have set up IRAs through their bank and not through their employer. Is there a way for them to use this instead of placing it in a state Roth account? Maybe year-end reporting would cover them. I do not believe there is a provision in the law for that scenario. It's either, if it's not a penalty on the employee per se, the penalty would be on the employer, right? So if they choose to not participate in the state's plan, if they opt out and they choose not to participate in their employer-sponsored plan, they opt out of that. They certainly could go through their bank if they really wanted to. There'd be no penalty to the employee as long as their employer is covering them, is following the rules as well. So, so I think that should be fine. Yes, question, will the automatic 5% contribution be based on the employee's gross or after-tax income? So it would be just basically the gross income of that's in their check, right? So I would do that calculation. If we were making a Roth IRA contribution or a Roth 401k contribution, that'd be on their gross wages as defined in the Roth rules. That's how we would do that payroll contribution. All right. I'm not seeing any more questions coming through, but certainly if you do have questions, I'm happy to help answer those. You can email us. Anyone on my team is happy to get questions answered. We've been doing a lot of research on this. We have some great financial advisors, accountants, retirement providers that are great resources. If we don't know the answer, we'll get you the answer. I will, again, put 3 cheers out for Henry. The state has done a great job of answering any questions that I've had. They're in the very beginning stages of getting this program launched and getting PR out there. We have over 100 people on the call today, whether they're clients. We have lots of accountants and financial advisors on the call here. So lots of good information that we're sharing. And I think Henry and his team are just getting started with their sharing. We definitely will keep more information out there for you in the coming months as things come along. We're definitely going to start working with our clients to make sure they're in compliance. And we will keep everybody posted as this progresses over the next few months. We will likely do another webinar in maybe February or March once we know more of what that state retirement program looks like as well. So keep your eyes and ears pierced for that. So, all right. Well, thank you so much for everyone for joining us today. We will post this on YouTube later today or tomorrow. We'll send out a link for everyone to review, and we look forward to talk to everyone very soon. Thanks so much for joining today.